3% doesn't sound that different from 3.5%, but when we're talking about interest rates, it could mean that you're leaving big money on the table. Today, I'm going to explain why that little bit of difference in interest rates matters both when you buy and when you invest. Hi, my name is Nicole. Welcome to my channel, Travel to Money. Before I get any further into this video, I just want to take a quick second to give you the disclaimer that I am not a financial advisor, and before you do anything with your money, you should always do your own research and consult a professional. Now, let's get unprofessional. I like math, but if you're not good at math, don't let that scare you away. Over 70 years ago, there was the first study of math anxiety when a woman introduced the term mathomophobia to describe the phobia-like feeling that many had toward mathematics. And according to experts, math anxiety can cause math avoidance. And let me tell you right now, if you're avoiding math when it pertains to your money, you're not doing yourself any favors. So today, let's face that fear together and look at some numbers that will blow your mind. Even if the math doesn't get any easier, I think some examples of real dollars will help to put it all into perspective. The economy has been interesting in the US over the last couple of years, and I'm sure you've heard about the high interest rates, which are specifically affecting those who want to buy a home. But before we dive into home loans, I want to give you an example of a savings account. Let's say you have your money in a basic savings account that pays the average interest rate of 0.6%, which is very little. You start out by putting a $10,000 deposit into the savings account and you add $200 to it every month. After 20 years, you would have earned a total of $4,247.63 in interest payments. Now, you might be thinking, $4,000 isn't bad. But let's take a look at the exact same numbers. But in this case, you're going to have a savings account that pays you 3.5% interest. That's not even quite 3% more. Doesn't sound like much. But if you kept all of the numbers the same, you started with $10,000 in the savings account and added $200 each month. At the end of 20 years, you would have earned $30,851.13 in interest alone. $30,000 in interest instead of $4,000 in interest just because you opened up a savings account with a bank that pays a higher interest rate. Now I'm going to give you another example. Let's say you see another bank that offers a 4% interest rate, and you already have your money in an account that earns 3.5% interest. You're probably thinking, it's not worth it to switch to a different bank just for that little difference between 3.5 and 4. But the person who does make the switch ends up with $36,679.58 in interest. That's another $6,000 of free money just for having your savings in the better account. Now, remember the first example I gave when we talked about the 0.6% interest rate? Well, what happens when you have the account for 30 years and you keep putting in that $200 per month? At the end of 30 years, you would have earned $8,811.18 in interest. Not awful, but not great either. What about 30 years in the account that earns 4% interest? Well, that account earned $87,488.09 in interest. So $8,700 in one account and $87,000 in the other account. It's just a no-brainer because you don't have to do anything extra for that. It's just having your money in the right place. Now, I want to remind you that this is a video about understanding interest rates. This is not a video about investing all of your money in a savings account. Just so that we're clear, let me make a couple of points. One, I don't keep a lot of my money in a savings account. I would rather have my money invested. The only money I personally keep in a savings account is my emergency fund, which is about $20,000 in a high-yield savings account that is currently earning 4.16% interest. So I'm earning around $65 per month just because my money is sitting in that account. And the account is free. Okay, point number 2 about savings accounts is that the interest rate can change. The reason the rate I'm getting on my savings account is so high right now is because of the Fed raising interest rates. So it goes up and down over time. When interest rates are low, the best you'll get on a savings account is usually between 1% and 2%. What I'm trying to say is, it always makes a difference if you can get a higher interest rate, but how much higher that interest rate will be depends on other factors. So don't go invest all of your money in a savings account. But also, if you have any money in a regular savings account, the message here is to get your money into a high yield savings account. I'm not currently partnered with any banks, but I will tell you that I currently keep my savings in Ally. I don't get anything to tell you that. They've been pretty good, and no matter what the interest rates are, they are usually pretty competitive with some of the highest offered. You might find some slightly higher rates with Citi currently and maybe others as well. Do some research. Ally has been great for me, so as long as they stay competitive, I'll probably be sticking with them. Okay, back to interest rates. Let's talk about how a good interest rate can save you money on something you buy, like a house, a car, or a credit card. This is the interest rate you pay when you have taken a loan out. Before I get too far into this, let me say that I have become a huge believer in having zero debt because I don't want to pay anyone any interest ever. Anytime I have a car, it will be because I have paid for it in cash, which is why right now I only have a 1999 Honda CR-V in Spain that I purchased for around 1,400 euro. I don't want to spend my cash or pay someone interest just to have something fancy that loses value as fast as a nice car does. Okay, but I understand why a lot of people have a mortgage. Often the costs are much less than rent and you're building equity. But this is where understanding your interest rate makes an even bigger difference. And let me give you a tip. If you're ever in a situation where you are making a purchase and the lender makes an offer of a certain interest rate, don't feel pressured to do fast math. Let them know you need a minute to better understand the numbers. You can pull up something called an amortization table or amortization calculator. I know it sounds like a confusing word, and honestly, even if you read the definition of it, you may be like, what? But put simply, amortization is like paying for something a little bit at a time instead of all at once. It's a way of spreading out the cost of something over a period of time. So with a calculator like this, you can put in the loan amount or the amount you're buying something for. You can put in the interest rate and then put in how many years your loan will last. I have one of these loan calculators on my website, traveltomoney.com. So we'll use that one to show our examples. Right now, the median home price in the US is $431,000. That is insane to me. The dumbest thing I've ever done in real estate was selling my house a few years ago. I bought a 3-bedroom house on a third of an acre with a pool and a dock along a canal for $195,000. I sold it a few years later and made a little profit, but now I can't even find a shack for $195,000. I digress. Okay, so let's use the median home price in the calculator and let's look at a 6% interest rate, which is so high, but that or even more is what the market has been looking like lately, which is why so many people are holding off on buying homes. And I don't blame them. We'll also put 30 years for the loan term because that is what most people sign up for. You have the option of adding a down payment. In this example, I'll put $43,100, which is a 10% down payment. You can, of course, put in the down payment you're planning to make. Usually, the least you can put down with certain loan programs is 3%, where 20% is what you should plan on if you don't want to have to add on mortgage insurance. Anyhow, let's get back to the calculation. Be sure to hit the calculate button. Then here at the bottom left, it will show you the monthly payment. Of course, this doesn't include taxes and insurance. This is just the loan portion of your payment. On the lower right-hand side, you just click this little graph and it will give you a pop-up screen showing you all of the loan details. So let's take a look at this one. At that 6% interest rate, if you made that monthly payment every month for 30 years and no more, you will have paid over $837,000 for a house that you thought you purchased for $431,000. And that doesn't include the $43,000 you put down on the house. It more than doubled the cost of the home. I know it seems like the math ain't mathin', but unfortunately, it is. Okay, I think you're getting the idea of how insane this is. But now let's take a look at that exact same loan, but with a 3% interest rate. Just so you have an idea, in 2020, loan rates reached historic lows that went as low as 2.65%. Generally, if you can get a loan at 3% or lower, that is a great find. But let's look at why 3% is so different than 6%. What do you think the difference on this loan interest will be over 30 years? $5,000? $50,000 or more? Let's look. When we go to the chart in the bottom right, we see that with a 3% interest rate, the price you actually pay for that $431,000 house is $588,745. That is a difference of $248,491. So, getting a home loan for an average house in the US and getting a 3% interest rate instead of a 6% interest rate means that you will save $250,000. $250,000. The defense rests. Or am I the prosecution? I don't know, but I think my work here is done. If you remember nothing else from this video, please remember that little numbers in interest mean big numbers in dollars. Now, what some people may do when interest rates are high is to go ahead and purchase their home at the high interest rate and then refinance the loan at a lower rate a few years later when interest rates are lower. You just have to make sure that you still have the income, credit score, and more to still be approved at the time you're wanting to refinance. Keep in mind that interest rates may affect how much you can even get approved for because the loan company wants to make sure you can afford to make the monthly payments. One last tip specific to loans is that whatever your interest rate is, if you pay a little more each month on your payment, you will help to lower the overall interest you end up paying. Well, I really hope you've learned a little something here today and that this has been helpful to you. I want you to have the tools and the resources you need to succeed. If you have questions, be sure to leave a comment or just say hello. Your comments always encourage me. Also, be sure to like this video and subscribe to join me every day where travel and adventure build financial freedom. I can't wait to see where your dreams will take you.